Ever placed a trade only to get stopped out right before the market reverses in your direction? Yeah, you're not crazy. There's a reason this happens, and if you don't understand this, you'll always feel like the market is hunting you. So today I'm breaking down the real deal behind price movements, liquidities, and stop hunts. Most retail traders think the market is just about support and resistance. Wrong. The real market is a battlefield of liquidity, and if you don't know where the big players are hunting for orders, you are the liquidity. After this, you'll never look at the market the same way again. For you to easily understand liquidities, I will give you a simple example. So let's say you're this guy, let's say you're in a forest and everything, and you're searching for food, you know? And let's say you find these berries, whatever, over here, you take them. What are you doing next? You're looking for the next one. Let's say you're going over here, you're eating it, and so on and so forth until, you know, you're looking for food. That's it. You're hungry, you need food, so you're doing so. After you take this food, let's say from over here, you're going to leave that place because you know there is no food remaining, and you need to actively be looking for food. So you may ask why I gave you this example. I gave you this example because really that's how price moves, especially in liquidities. So if you haven't watched my last video, make sure you watch it before going further into this video. There you have some nice fundamental things about liquidities as well, so make sure to check it out. Coming back to what I was saying, for the example I gave you, the person who is actually looking for food, it's actually the price section, while the food is theoretically highs and lows. So what do I mean by that? I'll take this situation over here. So you see the price drops down from over here to down here. That happens because a lot of people in this area shorted the price. So let's say I've entered over here, and most people put their stop losses at the high. So what happens is price moves down, and when price comes back to your stop loss, you can see then a clear direction moving in your initial take profit or direction that you took your trade in. And you may have seen this happening a lot in your trades. If you have ever placed a trade, a good looking setup and everything, then your stop loss is hit, and 1 hour later or something like that, then your take profit as well is smashed through. It works like food, you know? You take this food over here, you're not going to sit around, you're going to the next one, and so on and so forth. These are called liquidity grabs. When you have a liquidity and then the price comes over there, take it and reverses in the initial direction. Another one as well over here, a liquidity grab. Another liquidity grab is here. Although it might seem like the price is going in that direction a lot deeper, it actually reverses back because if you go back in time, you have more liquidities. And it's really important, if you have multiple liquidities in an area or a zone, there's a higher chance for price to go there. It's like, as I said, the example with the forest, you have multiple berries and a lot of food in an area, you are more likely to go in there than to choose the area with less food. So you have this happening, price went down a lot, took these liquidities, came back up, took this other liquidity, and then came back down. But this doesn't happen like this always. And you could consider liquidity as a fuel as well, because if price wanted to go down more than this price, it needed more food, you know, more energy, and it could not do that without taking more liquidities. So let's say you are right over here, okay? And you know this concept that I just told you, that you need a lot of liquidities for the price to move. What will you do? You would expect the price to move over there before going down. And by the way, you can enter in the Discord channel. There you have some nice resources. I'm actually going to upload a course that is really going to be comprehensive, and if you don't have a vast and broad knowledge in trading, I think you should download it. It's actually free, so go check it out. And I forgot to mention, you can as well start new conversation with your fellow traders, because we have a small community at the moment and we are looking to grow it as much as possible. So as I said, go there. I have some surprises for you as well. There you can see the broker I use and much more, so waiting for you there. let's say over here, you know, you have this high, price came over here, it went down. What it formed? Another high and another low. So you have this high over here, this low over here, and this low over here. You see the price did not really sweep that low. It was not a liquidity grab. But what really happened? And you may ask yourself, okay, it didn't go there, even if it should go there, right? Because as I told you, the price needs fuel for it to continue moving lower in this scenario. But it took this liquidity, because as well, this is a high, which was formed later. So it still had some fuel. It wasn't necessary for the price to come over here. And this is a mistake a lot of traders makes, you know, let's say you are going for a trade over here, you see a setup, I don't know, and you're being greedy and you put your take profit over here. And it's just, you're not going to hit your take profit by 10 ticks or even less, because your actually liquidity is over here. In the future, you'll see the price moving up, taking all these liquidities. And maybe you have heard about trend lines. This is of course another retail strategy, and they are liquidities, support and resistance. So I'm going to get deeper into them if you want, so in a next video. Today I'm only talking about liquidities, so it's simple for you and we can focus on this topic. So now we can assume that the price doesn't move randomly, and slowly you start to realize that trading is not a gambling thing that others tend to say it is. So you may have heard also about manipulation and how big players like BlackRock and others, big hedge funds, manipulate the market. That thing is true, and that really happens in trading especially. So I'll give you an example. Let's get right over here. Let's go on 15 minutes, so it's easier for us to see the price action. So I'll give you the example I gave you in the last video. So let's say I'm a big company like BlackRock and I want to buy, let's go for 1,000 shares, you know, and it's a scenario where I can't really do that at this price point because there are not enough sellers. So what I'm going to do? To target stop hunts or to target zones where there are enough sellers. It's like, let's say I'm a leader for a big tribe and I want to provide food and I need a lot of food. I can't go with like 10 berries because they will starve. So it's something similar. I can't come over here and buy those shares because, as I said, there are not enough sellers. So what I'm going to do? I'm going to sell. So you are selling as a big company. Let's go for the bid. Okay, this was a news, but this happens without news as well, so it's not really a big problem. And when I'm selling a bid, let's play this price movement was a little smooth, not one big candle. And when I'm saying then the price is moving down, why am I really doing that? Because when I hit these liquidities, price where are stop losses, where the stop losses are resting, and in those areas there are enough sellers. So let's say over here there are 200 sellers that are selling 200 shares. Here let's say 500, and the rest of 300 are over here. So when prices was in this area, I managed to buy those 1,000 shares I was looking for. And when I basically liquidate everyone, then the price is stalling. When the price is stalling, it never stays like this in here, you know, because you have bidder and ask, and it is going to go up. That's how it works. And the price goes up, and of course I am profiting as a big company. And that's why they want you to hit your stop losses, because there are a lot of money, there are a lot of people, retail people, that are buying and selling, and they want to take your money, not because they profit from your loss, but they profit from the fact that you don't know how market works and what liquidity is. That's why you need to grasp these fundamentals and go deep into it and master it. And I'll give you another example just for you to not say that it's a coincidence or something like that. They have a consolidation phase, and the consolidation phase, it was, let's go for a replay so it's easier for us. It was like this, you know, no liquidity was hit, liquidities were forming, as you can see. One over here, one over, trading view does not want me. to show you guys. Okay, one over here and another one over here, and so on and so forth. You have this one, and before this was created you had this one as well, which was a smaller one. And what happened the moment it took this liquidity? What do you expect the price to do? To go for these ones or to take more liquidities before hunting the others? It's like give and take, you know. If you take, maybe it's not bound to that, but usually if you take 3 buy side liquidities, then you expect to trade 3 sell side liquidities. It's usually even, and after this happened, you will see the price going up. It went close to this liquidity, then took all of these 3 liquidities in one 15-minute candle. This shows a lot of bearish potential, especially, and it's something very important. You may ask me when you can make the difference between a liquidity grab and a real break of structure. I'll tell you immediately after I will show you this example, because we have one right before. So these liquidities were taken, then you can see the price stargazing and going down. And let's stop over here. One thing you can do is when you see price moves extremely fast in a direction without the wicks. So you see here you have a clear body, a close over this high, and you can assume that this is not a liquidity grab, but you maybe could take a trade wherever in this area. In the future I will give you examples on how you can take trades, fair value gap and more. On the lower time frame this will be a liquidity, and you can put your take profit over there, so that's your profit, and so on and so forth. And this can happen over here. You could took a trade the moment you have seen this week around this area. You could have taken a trade and hope for the price to go here at these liquidities. So you might ask as well how to avoid getting hunted. So it's pretty straightforward. You always wait for the liquidity grabs. So even though you may think, let's say over in this scenario, you are like, okay, the price is going down. Let's go back a little bit so you don't get okay. You'll feel like the price is going down, I'm going to miss this move, and FOMO comes in, the fear of missing out. This should never happen. A trader should not have these emotions, so you need to wait for the liquidity grab. You are not going to enter in here until you know these liquidities, these 3 of them, are not hit or swept. Another thing is, don't put your stop losses where others do. So it's very straightforward. If you happen to enter over here, you know, don't put your stop losses here where others did, where the liquidities. Go for a little higher, you know, where you don't think the price will go. That's a risk management thing as well. It depends. If you have a risk management which is going to be less than 1 or 2, you should not do that and wait for a better trade entry. It depends on your strategy as well, but as I said, look for your stop losses not to be where the others are. Another important fact is to look for volumes as well. In a stock market it's a little bit harder to focus on this, but maybe in crypto, as you can have the volume indicator as well, you can focus on that. So you have a better idea if the price is going to respect the liquidity level and go in the other direction, or go through it, strike through it and continue its direction. And another thing for liquidities as well is you can take profits based on it, so it works the same thing as the stop losses. And you might have heard of smart money as well. Usually smart money are referred to the big banks or those who know how to trade with them and not being stopped out by them. And I'll give you a few examples of how retail traders trade and how you should trade if you want to be a smart money trader and go with how it's actually supposed to be. So if you haven't heard about support and resistance, I'll explain you shortly. Don't use it, so if you don't wanna know what it is, it's alright. It's actually zones. This is a support and resistance. Most traders calls it a floor, and it's actually where price bounced a lot, you know, And it doesn't work like that. Trading isn't just drawings and you may have seen unicorns, dragons, whatever. It's not like that. Trading isn't that simple. If it was like that, everyone would be a millionaire. And in this scenario, somewhere this level is a support and resistance. And a lot of traders are trading based on it. So let's say, I don't know, you're over here, you see this happening, and of course you go with the trades and put an order over here, put your stop loss over the resistance, support, whatever it is. I'm not trading it, so I'm just giving you an example, guys, you know. And you wait, the price goes in your direction. At the moment you have your take profit, let's say over here, and boom, you see this happening. Your stop loss is hit, because that's how liquidity works. It can't go down until you want to. That's not how the market works. They're not waiting for you. The market is dynamic. If you are remaining in the past and you're not evolving and you're not seeing what actually happens live in the market, you're going to be used as liquidity. And that's the reality, you know. You have to understand that now, not how you should trade. You should use these liquidities, and you need to learn them. You need to learn where they are and use them in your favor. In this scenario, for example, you see here are a lot of liquidities. You're not entering until these liquidities are not taken. And let's say they are not taken, you know, and the day ends. No problem, you're not taking the trade. You should not focus on taking a trade every day. If you ever feel like the market is against you, now you know why. You are playing in a system designed to take your money, unless you flip the script. In the next lesson, I'm going to teach you how to track institutional moves before they happen, so you can trade with the big players, not against them. Make sure to like, subscribe, and drop a comment if you have ever been stopped out right before a big move.